Hi friends, this is not a clickbait video because in this video I will share with you 10 money hacks across various assets including ETFs, mutual funds, stocks, insurance, income tax and many other assets that are not there on YouTube anywhere. Every 2 to 3 minutes you are going to learn something very powerful to help manage your money. And people who do not know me, my name is Rahul Jain and I am a full-time investor. With that, let's get to money hack number 1, which is on ETFs, how to trade ETFs smartly. Have a look at my screen and you will see a bunch of exchange traded funds, ETFs. Allow me 2 minutes of time and you are going to learn a lot about them. So the screenshot that you see was taken during the 4th of June 2024 election day when the market was crashing like anything. And during the day, majority of the ETFs were falling like crazy. See the first one here, mid-cap ETF that fell by around 9.17% during the intraday. The second one that you will see fell by only 4.82%. And the third one here you see fell by around 2.74%. Now the fun part is that all these three ETFs are following the exactly same index, which is mid-cap 150 index, which might have fallen by let's say 4%. But the first ETF fell by 9%, second one fell by around 4.82%, and the third one fell by around 2.74%. So at that point in time, investing in the first ETF will make a lot of sense because you see that it is down by almost 9%, while the index might be down by around 4 to 5%. And that very day I invested in the first ETF and I shared that very honestly on my YouTube member community. And if you are not yet a YouTube member, consider subscribing to my YouTube member community. I don't have any paid courses. The only way I teach is practically using my YouTube member community. So if you're looking for timely insights and analysis, consider joining. Give it a go for 1 month and see whether that improves your investing style or not. Now coming back to these ETFs, this also happens when the market is rising very heavily because each ETF might behave very differently. And the natural question here is that, Rahul, why does this actually happen? Is this because of the tracking error? See, the tracking error is the end result. It is not the reason for ETFs to behave very differently like this. The main reason ETFs behave very differently is because of the individual demand and supply of each ETF, because ETF behaves very similar to a stock. At a given point in time, if there is more buyers of a particular ETF, then the demand of that particular ETF is very high. It is going to trade at a premium. And if at the same time there are more sellers of a particular ETF, then what is likely to happen? The price of that ETF is likely to come down, and that presents you an arbitrage opportunity to buy or sell or trade on ETFs. So people who blindly invest in popular ETFs such as Nifty Bs, etc., what I would say is please go ahead and take top 5 ETFs from a liquidity perspective. See the volume of these ETFs. Shortlist those top 5 ETFs and depending on which one has fallen more, that is the one you need to go for. Secondly, if market is going crazy rally, then in that case you need to think about selling your ETFs, and in that case you need to consider that one which is trading at a premium. So this entire narrative of demand and supply of ETF is what you need to know. Different ETFs behave differently, although they might be following the same index. The second one is on life insurance or term insurance. If you or someone in your family or someone in your friend circle is trying to buy a life insurance or term insurance, please do not buy a policy that goes beyond 65 years of age, because as you can see on my screen, the premium after the age of 65 years of coverage goes very high. Steeply it goes up. The difference might seem to be around 2,000 rupees per year, but please understand one will end up paying this 2,000 rupees per year for another 30 to 40 years. And if I do some quick calculations, 2,000 rupees per year for 40 years at index returns of 12% will build around 17 lakhs for you. But Rahul, at the same time, I'm also getting the insurance cover after 65 years of age. My question to you is that why do you need insurance after 65 years of age? By the time you hit 65 years, would your children not be financially independent? Would you not have built a solid corpus for yourself? So in my view, buying an insurance policy that goes beyond 65 years of age is a very costly affair. Now, in all honesty, this hack is not my hack. This hack was provided to me by Ditto Insurance. If you go to their website, Ditto Insurance do not recommend taking an insurance policy beyond 65 years of age. And I genuinely like this honesty when many other insurance providers are hard selling insurance. Take this insurance for 70 years of age, 75 years of of age, Ditto Insurance is being very honest and telling you that if you buy a policy after 65 years of age, your premium is likely to be very, very high. Therefore, I really like the honesty of Ditto Insurance platform. And it's not just me. On Google, they have earned a rating of 4.9. Ditto is backed by Zerodha, taking their credibility to another level. Also, Ditto is a spam-free platform, will never send you unnecessary messages or unnecessary calls. In fact, you can get a free consultation of 30 minutes with their expert advisor. Simply go to the link provided in the description or in the pinned comments, fill your personal details, choose a date and time, sit back, relax, and wait for their expert advisor to call you. Hack number 3 is for people who want to invest in index funds. Many people ask me that, Rahul, how to go about analyzing index funds? For example, I want to invest in Nifty 50, Nifty Next 50, Nifty Value Index, and all that good stuff. So I'm going to show you a very simple and free website where you can go ahead and analyze index funds. So the name of the website is TickerTape. I'll give you the link in the description. Simply go and click that link and you will come to this website. Click on screener here first and you can do stock selections as well as you can do mutual fund selection. So click on mutual funds and then click on start screening. Now there are more than 1400 mutual funds on this website. So what you do is simply go into equity here and click on index funds. So it will bring you only the index funds, around 135 index funds. Now the question comes that, Rahul, I'm not interested in all these index funds like Nifty Next 50 here and all that. I only want Nifty 50 index funds. How do I go about filtering it out further? In that case, you go and click on add filter here, and in the search for filters, look for benchmark. So let's go ahead and type benchmark here. Click on benchmark and you will see the benchmark coming somewhere down here. Simply click on the benchmark, and in this benchmark box here, select the index fund benchmark that you want to select. So for example, here I want Nifty 50 TRI. So I will go ahead and select the Nifty 50 TRI here, and this website now will give me 18 index funds here which are tracking the Nifty 50 index. Now what I can do is I can add a bunch of other filters. So for example, add filter here, and I can go and look at the expense ratio of these. For example, I can go ahead and add that here. So it will come here to the right. Now what I can do here is I can add more filters. So for example, I come here and I can look at alpha. I can look at the last 3 years average annual rolling returns. This is only for the pro members, by the way, but there are other bunch of free filters that you can quickly go ahead and use here. Absolute return, last 3 months, 1 year, and so on. And they will all come here. You can export it in the Excel for your analysis and so on. So this is a great way of analyzing index funds where you have all these index funds in one place with lot of free filters that you can use. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, let's move to hack number 4, which is around mutual fund SIP investing. Most people know about SIP, but many people do not know about the SWP, Systematic Withdrawal Plan. Let me show you the power of SIP plus SWP. Let's say that you are a mutual fund investor and you have been doing 20,000 rupees per month of SIP in the last 3 years. And let's assume that this money has grown at a 15% CAGR in the last 3 years. So at the end of 3 years, you will be sitting at a corpus of around 9 lakh rupees. Now at the end of 3 years, let's say your money goal is achieved and you want to use this money maybe for your house down payment or for your honeymoon or wedding or whatever. And you want to withdraw this 9 lakh rupees after 3 years. There are 2 problems in that. Number 1 is when you withdraw this money at the end of 3 years, you have already taken a very big risk of market fall. What happens at the time of withdrawal? All of a sudden the market corrects by, let's say, 5%, 8%, 10%. The money that was compounding for you at 15% CAGR all of a sudden will go down in value. This has happened multiple times when during the COVID, all of a sudden market fell by around 30 to 40%. These market crashes can happen any time without proper warnings. So the point here is that every month, the way you have done the SIP investing, you need a simple strategy of exiting your money in the similar monthly fashion. And this is where SWP comes. But let me explain to you the second problem here, which is the long-term capital gain tax. Government has been increasing long-term capital gain. In the recent budget announcement, they increased it from 10% to 12.5%. And if you withdraw this money after 3 years, then you will need to pay 12.5% of long-term capital gain tax on your profits. Therefore, withdrawing all your money in one go after 3 years, you are going to lose a lot of money in tax. What you really could do is that every single year you can withdraw up to 1.25 lakh rupees of profits. That is long-term capital gain tax, which is totally exempt from taxation. Withdraw it and put it back into the same mutual fund so that you still do your compounding. But coming back to not exiting your mutual fund after 3 years, what you need to do is you need to leverage the power of systematic withdrawal plan. Almost every demat platform will provide you this feature of SWP. You simply go and click on the SWP button and you set up the monthly amount that you want to withdraw. You might want to withdraw, let's say, in the 3 months time period or 6 months time period, so that you're not withdrawing everything in one single go. Since you're withdrawing into 3 chunks or 6 chunks, it might slightly lower your returns, but you are de-risking your money when you're exiting from mutual funds. So the combination of SIP and SWP needs to be in place to lower your risk. Number 5 is sovereign gold bond. There is a lot of hoo-ha right now in the market about sovereign gold bond. Allow me 2 to 3 minutes of commentary and you will get a crystal clear view on sovereign gold bond. So the first batch of SGB was issued in November 2015 at a price of 2,684 rupees per gram. It got matured in November 2023, and if we look at the returns that it has given, the only first one has been matured so far. So I cannot speak about what will happen to the future batches, but for the first batch, if you look at some calculation, you will see that people who invested 1 lakh rupees, their money have grown by around 13.63% CAGR, out of which 10.88% is the gold appreciation every year, price appreciation in the gold, and 2.75% is the interest given by Indian government per year. This 2.75%, by the way, has now changed to 2.5%. Now the beauty of sovereign gold bond is that on this 13.63% every year return, you don't need to pay any long-term capital gain tax. This is the beauty of sovereign gold bond. This is the biggest advantage of sovereign gold bond in my view. If you would have invested this money, let's say in mutual funds or stocks, then you would need to pay 12.5% long-term capital gain tax right now, which will come out to be around 15,800 rupees on this particular price. So your overall returns will come down from 13.63% to around 12.53%. But the point here is that this long-term capital gain tax right now is only 12.5% on stocks and mutual funds, etc. Can this go up in the next 5 years, 10 years time? It is very likely, and this is where sovereign gold bond gives you that benefit of saving long-term capital gain tax. Rahul, is there any risk in sovereign gold bond? There is no big risk in sovereign gold bond, but there is one particular thing that people are making big hoo-ha about, which is that Indian government may reduce the custom duty as they have done in the budget announcement recently. And what that has done is that the gold prices have come down. And people are saying that this has been done intentionally by Indian government because they know that in the next few years, all these SGB batches are going to mature. So therefore they want to bring the prices down so that the government have to shell down less money. But please understand, gold prices are not only determined by the custom duties. There are a lot of other factors like how much of gold central banks are buying, what's the demand and supply, what's the geographical situation. So there are a lot of variable factors here that will influence gold prices, not just the custom duties. But yes, you can consider that as one of the risk here. Now, if you ever want to invest in SGB, one option is that whenever Indian government issues the new batches, you go and buy it. I don't know whether they will issue it or not. They might stop it. I don't know that. But the good second option is that you go and buy it from the secondary market. So if you go to this NSE website, I'll provide you the link. You are going to see all these SGBs listed here, and you will see their issue price. You will see their current trading price as well, and you can just filter it by low to high or high to low. So for example, here low to high, high to low, you can just see these prices, and more often than not, you will find that these prices are at lower discounted price. I created a full video on this. You will find that in that particular video, SGB prices were trading at discount. Here right now, the SGB prices are trading at a premium right now, because very recently the gold prices have come down. Therefore, it depends really on the demand and supply. Right now it is at premium. But anyways, depending on if you're happy with the prices that you want to pay for your own holding period, what you do is just copy this particular code that you like, anyone. So for example, I'm going to copy this one here and then go ahead and post it here in Zerodha, and you are going to see that here coming up. You add this in your list, go ahead and do your buy as you buy the stock. So it's very simple to go and buy secondary SGBs if you are interested in that. I'm not saying that you go and invest in gold. I'm not giving any recommendation. I'm just teaching you a method in which you can go and buy sovereign gold bond through the secondary market. So far, if you're with me, hit the like button. Let me know in the comments a simple thank you. It motivates me and my team to do a lot of research for you and bring content to you at zero cost. With that, let's move to hack number 6, which is where to see SIP returns. Many people ask me, Rahul, I want to see the SIP returns. So this website, Advisor Coach, will give you exact SIP returns. You'll find the link in the description again. Simply go to this website and select the mutual fund category that you're interested in. For example, large cap here, or you can go ahead and change it here, anything that you like. For example, here you might go for, let's say, ELSS, flexi cap, and so on. Select your time period. You want to look at the SIP returns in the last 4 years, 3 years. Put the SIP amount that you wanted to do or you wanted to check the return for. Select the plan type and simply click on submit. It will give you a lot of details here. It will arrange them in the order. So for example, here Nippon India large cap has given 30% XIRR. These are the SIP returns, and at 3,000 rupees per month, you would have invested 1,44,000 rupees. That would have become 2,56,000 rupees almost. None of these mutual funds are recommendations, but it's a very, very simple way of going and finding SIP returns for any mutual fund categories, and it gives you XIRR returns. More importantly, that's what you're after. Let's move to number 7, which is stock valuations using PE ratio. Have a look at my screen and you will see Reliance Industries PE right now at the time of recording this video is at around 29.61, while the industry PE is at around 11.50. Do you think from a PE perspective it is overvalued or undervalued? Rahul, yes, of course it is overvalued because the PE is very high compared to the industry PE. But here is the catch that most people don't understand. The industry PE that you're seeing here is for refineries here, as you can clearly see. But my question to you is that does Reliance only operate in refinery segment? Well, of course not. And this is where I did my own calculations and I posted that on my YouTube member community. If you're still not a YouTube member, consider becoming a YouTube member. You are going to learn a lot about investing. Here, my perspective is very, very simple that Reliance Industry operates in 4 sectors, as you can see here clearly: oil to chemical, retail, telecom, oil and gas. So I have to actually calculate industry PE that represent these 4 sectors. So how to go about it? I've simply got PE ratio of all the 4 sector here or all the 4 industries here. I've now taken the Reliance revenue split from all these 4 sectors. As you can see, oil to chemical contributes 57% of Reliance revenue. Retail contributes around 28% of their revenue. Now, in order to arrive at the right industry PE for Reliance, what I've done is I have taken a weighted average of revenue and the industry PE. And if I sum it up, I get an amalgamated industry of 29.2. And now if I compare 29.2 with Reliance PE of 29.61, all of a sudden the equation changes here and my valuation parameter changes here. Again, I'm not giving a recommendation here for you to go and buy Reliance Industries share. I've done a simple calculation that shows you how to go about using PE in a right way. Number 8 is take position in those assets that are crashed like anything, but you have a conviction in them for the long term. Let me say that again. Take positions in those assets which are crashed like anything, but you have conviction in them to hold them for the long term. For example, a month back on my YouTube member community, I wrote a detailed post about my investments during the crash time on the election day. I'd invested around 14 to 15 lakh rupees and I'd created a full video on that publicly as well, sharing all of that detail. And these assets that I bought, you see on my screen, these are fundamentally good assets that I'm happy to hold for more than 5 years, 8 years of time frame. And within 37 days of time, these assets gave me around 13% returns on a capital of 14 lakh rupees. Now, I'm not saying that these are the only long-term sensible assets. You might have your own views in terms of where do you want to invest. My point is very, very simple. When markets are falling and at that time you have the conviction in particular long-term assets, you can go and build your positions, because in the long term, this appreciation will compound and compound and compound, and you will be really sitting on good profits. Of course, there is always a risk. There is always a fear. You don't know where the bottom is. And as an investor, you always need to take that chance. You always need to take that risk, because remember, in any asset that you invest other than FDs or the fixed returns, there is always a risk. And as an investor, you should be happy to take that risk. Moving on to number 9, which is on income tax. Recent budget announcement on capital gain taxes hugely disappointed me and many of you. But coming back to income tax here, EY have done some number crunching published on Economic Times. And what you see here is that if your salary is at around 7.75 lakh rupees, you will not pay any tax in the new regime. And if you want to remain in old regime and not pay any tax on this, please make sure you are claiming minimum 3,25,000 rupees of deduction in various heads. And if you're not able to claim minimum 3,25,000 rupees of deduction, then you will end up paying more tax in old regime please consult your CA and try to move into new tax regime if you're not able to claim minimum 3,25,000 rupees of deductions. Likewise, if your salary is 10 lakh rupees in new tax regime, you are going to pay 44,200 rupees as taxes, and for you to pay the similar taxes in the old regime, which is 44,200 rupees, you must make sure you are claiming at least 3,50,000 rupees of deduction. And if you are not able to claim 3,50,000 rupees of deduction, it's best to move to new tax regime. Again, I'm not a CA. Please consult with your CA. But this data is published by EY in Economic Times. Very useful data that I want to share. Look at these salary slabs: 7.75 lakhs, 10 lakhs, 12.5, 15.75 and so on. And please make sure that you are claiming at least this much of money in each of these salary levels to be able to remain profitable when it comes to income tax in the old regime. And if not, move to new tax regime. Number 10 is liquid ETFs. I had created a full video on liquid mutual funds, giving you the utility of them in terms of building your emergency fund. And if you have some cash lying around, liquid mutual funds or liquid ETFs are a good way to park your money because they give you a little bit more interest than the savings account. So for example, recently Zerodha launched their liquid ETF, and you can see on my screen here that the savings account generally, if you have your cash in your bank account, for example, gives you around 3.53% return on a yearly basis. While in liquid ETFs, you are likely to get somewhere around 6 to 7% depending on the market conditions. So for example, if you have, let's say, 10 lakh rupees of cash with you and you are going to use that in the next 1 month, maybe you are waiting for some house down payment, or maybe you are waiting for you to park this money in mutual funds or stocks, and you're looking for some right opportunities to come your way, then what you can do is, one option is that you leave this money in your bank account. You are going to get how much of interest? Around 3 to 3.5%. While if you put that in the liquid mutual funds or liquid ETFs, you are likely to get around 5 to 6%. Now, if you do a very quick math on the 10 lakh rupees, if you look at the interest, which is going to be 3.5% from savings perspective, it's going to be around 30,000 rupees for 12 months. So for a 1 month of holding period, it's going to be around 2,500 rupees. While if you put that in the liquid mutual funds or liquid ETFs, you might get around 7% returns, and that might come at around 60,000 rupees for 1 year. So for 1 month, it will be around 5,000 rupees of interest. Of course, both are taxable, but it might give you almost double the return even in a shorter period of time. You can go to your demat provider and just simply type liquid case, and this particular liquid case by Zerodha will come, and you can go and invest in that. Again, not a recommendation. I'm telling you the ways to improve your money management skills. So in this video, I've spoken about 10 money hacks that practically some of them I've used, and I've given you a lot of content around it. Let me know in the comments which one do you like the most, and do you find all these 10 useful or not? Let me know in the comments. I would love to read that. Also in the description or in the pinned comments, I am giving you a lot of links. One is on sovereign gold bond, where to go and buy that, index fund comparison, SIP returns by advisor course, also Ditto insurance platform link. Please go ahead and use these links. They will help you a lot in your life. With that, I'll see you in my next video. Until then, keep rocking.